Whether you've been managing your finances for years or are just getting started, it can be challenging to determine when to save and when to invest. Are you unsure about when to save and when to invest? Find your answers right here. Do you have trouble with managing your finances, or are you just confused about all of the numbers swarming in front of you? Well, fear not. We've got you covered. Here at Financial Synergy, we help you with your educated journey towards financial freedom. Saving and investing are two distinct approaches to financial security. The act of putting money aside for future use is known as saving. Investing is the process of purchasing assets to profit or gain revenue. These assets can range from collectibles to real estate, but the most prevalent are securities such as stocks, bonds, mutual funds, and exchange-traded funds, ETFs. Both savers and investors postpone spending now to have more money tomorrow. This is one of the reasons why people use the terms saving and investing interchangeably. Both techniques are based on the idea of practicing financial discipline today in exchange for a more prosperous future. So, how do you decide when to take the safe road and save, and when to take a chance to gain higher returns and invest? Here's what you should know. What exactly is saving? Saving refers to the process of putting money aside for future purchases. The reason for saving is usually because you don't have enough money to buy what you need right now. Therefore, you need to save some of your income regularly until you do. The most critical aspect of saving is to ensure that you have money when you need it. To keep your money safe, you can bury cash beneath your mattress or, more often, use a savings account at your bank. Advantages and disadvantages of saving. There are numerous advantages to saving rather than investing. First, if you don't make withdrawals, the dollar amount you save in a savings account will not decline over time. This is significant because some objectives must be met regardless of whether investment prices are rising or falling. Saving rather than investing allows you to attain your objective on time if you save the appropriate amount each month. Divide the total amount you need to save by the number of months until you reach your goal to determine the amount you need to save each month. However, there are drawbacks to saving. Each year, the value of the money you save decreases due to inflation. If you earn interest, it may help to offset the negative impact of inflation. Unfortunately, interest rates rarely keep pace with inflation. Saving also implies that you will need to set aside more money each month than you would if you obtained higher returns on your investments. For example, if you're only earning 1% interest on your savings account but could earn 8% on your investment, you'll need to make up the difference by placing more money in your savings account to meet your goal at the same time. What exactly is investing? Investing likewise entails setting money aside for the future, but the primary distinction is the reason for doing so. The goal of investing is to grow your savings quicker than is possible in the savings account to have more money in the future. Bigger investment earnings are attainable by accepting a higher risk with your money, which means that investments might go down as well as up in value. Investments can be made through a brokerage account or a multi-asset investing platform such as Flowbank. The benefits and drawbacks of investing. Investing can also be advantageous. For example, investing allows your money to increase quicker than it would in a savings account. Your returns will compound if you have a long time until you need to reach your goal. This means that your investment earnings will make money over time in addition to a better rate of return on investment. The advantage of more significant compounding returns is that you won't have to invest as much each month as you would have to save to accomplish your objective. Investing, on the other hand, isn't necessarily a positive thing. Investment prices may fall just when you need the money, putting you in a financial jam. If this occurs, you'll have to choose a less expensive choice, postpone your objective until you can save more money, or postpone your goal until the value of your investments increases. The difference between saving and investing. When you save, you keep your money in cash. You may put the money in a high-interest savings account or a shoebox in your closet. When you invest, you exchange cash for another asset. You then anticipate the asset to appreciate, generate income, or both. For example, you might buy stock with the hopes that it will appreciate and give you dividends over time. Alternatively, you might purchase bonds or bond funds to get interest payments as income in the future. When should you save and when should you invest? It might be challenging to know whether to save or to invest. Each person's goals and conditions are unique. Your decision should be based on your scenario. If you are unsure what to do, you should consult a financial advisor who can assist you in making the right decision for you. However, there is a general structure that works for a wide range of people. Step 1. Create a retirement account. First, check if your 401k or other company retirement account offers a matching contribution. If your employer matches the funds, you should be able to contribute to your retirement account. Their balance matching is practically free money, so you shouldn't pass it up. Step 2. Create an emergency fund. Next, set aside $500 to $1,500 in a savings account for an emergency fund. A small emergency fund is critical for staying out of debt for good. Rather than putting minor crises on your credit card, which could lead to more debt accumulation, you could use your emergency money to cover minor situations. Step 3. Pay off your debts. Pay off high-interest debt after you've built up a little emergency reserve. It is up to you if you decide what constitutes a high interest rate, but it must contain loans with 10% or greater interest rates. Step 4. Fund your retirement accounts to the hilt. After that, invest in and max out an IRA. Whether you choose an IRA or a Roth IRA, it's entirely up to you, but you should invest in a tax-advantaged account in either case. In 2018, you could contribute up to $5,500 per year, plus an additional $1,000 per year if you are 50 or older. After that, fund your employee retirement account to the brim. This is done after an IRA, since you have additional alternatives for investing your IRA. You can pick where your IRA is held and what it invests in, whereas a corporate retirement account is limited to the alternatives available through your plan. You must also consider one-time objectives. You'll also need to save for big one-time ambitions like buying a house or a car using cash. It is up to you to decide where you want to place these objectives within the framework outlined above. You'll balance these objectives with your retirement investment to ensure that you meet both objectives within the time frames you're comfortable with. Depending on your flexibility and the time range of your goal, you'll have to determine whether to save or invest to achieve these objectives. If you absolutely must meet a deadline, you're probably better off saving rather than investing. On the other hand, investing may be an option to consider if you're a little more flexible about attaining a goal. You could earn better returns on your investment, but a bad year in the markets could cause you to miss out on your target date. How to choose between saving and investing. It can be challenging to decide whether to save or invest for a specific objective. Here are 2 ideas to help you determine which is best for you. Save money if you have short-term goals. To begin, if you must have the money by a specified date, save rather than invest. Then there's no risk of your balance diminishing when you save. Investments, on the other hand, might lose value. If you have long-term goals, invest. Next, investing allows you to earn higher returns if you have a more flexible time frame, and you can delay your goal if things don't go as planned. The secret is to be able to postpone your goal. For example, if your investments were down when you expected to attain your objective, waiting a few years may result in your investments reverting to a greater value. Alternatively, do both. Of course, you can combine saving and investing. You can save the money you require and invest the money that would be good but isn't required to fulfill your primary aim. Another alternative is investing towards a long-term goal and gradually transitioning to saving as the objective approaches. This helps to avoid a rapid reduction in your investment values, which could cause you to miss your target. The general rule of thumb is to prioritize saving if you need funds soon and investing if you plan for your long-term financial future. Aside from your financial objectives, you should consider your risk tolerance. For example, if you are worried about the prospect of your investments losing money at some point, you may not be able to invest. However, with sufficient information of the long-term predicted profits in the stock market proportionate to the risk, most people who are hesitant to invest come around eventually. Hiring a financial advisor is one method to overcome the fear of first-time investing. Finally, it is up to you to decide whether saving or investing is the better option for achieving your financial objectives. And of course, how and whether you invest, save, or do a combination of the two will most certainly change over time as your priorities and ambitions shift. We hope you have learned something from the video today and start making your money work in your favor. Make sure to subscribe to the channel for more videos like this. This is Financial Synergy, and we'll see you again next time, Finance Warriors.